Yes, like Reagan said, we want to thank everybody for coming. About 2 weeks ago, we didn't have a lot of people registered. Now the room's full, so that's exciting from that perspective and the people online. So we put together a good panel of people from different perspectives when it comes to planning, especially related to the ag space along those lines, which is the purpose of the presentation for strategies for a smooth farm transition. Just a few agenda items that we really want to try to cover as we go through, talking about different potential legal structures, evaluating different financing options, preserving family relationships, valuation and tax impacts, and then starting succession planning with confidence. Some things that people typically don't want to think about or want to avoid from that perspective. From an introduction perspective, my name is Jared Dodd. I'm a tax shareholder here with Lutz in our Grand Island office. Reagan did find a good picture of me before my beard turned gray, so we'll let everybody else here at the table introduce themselves as well. Ryan, you can go first.
Yeah, I'm Ryan Rivera, Consulting Director. They also got a picture of me with a little bit of hair. It was going. Embrace it. I'm in the Omaha office. I'm in the M&A space, so it could be at our department. We do kind of three different things. I do a lot of business valuations, estate planning, SBA. Pretty much, if it can be valued in a business, we try to do it one shape or form. But then we have a sell side where we do take out certain businesses to market, and we do have a buy side where we do QMEs. That's kind of our Let's M&A team.
Spencer Hartman. I'm an estate planning business attorney at Rembold Ludkey. We have offices in Lincoln and Seward. Kurth is in the front row on the end over there. He works in both offices, but is a good representation of our Seward office. We do have clients in all 93 counties and service clients in agriculture and business throughout the state. So my key areas would be estate planning, business, transactional, and real estate. For me, those three buckets sort of flow together typically because our estate planning clients have businesses, they have real estate, vice versa, it flows together. And a heavy portion of the work that I do is rooted in agriculture, either agribusinesses or ag families.
Tyler Hohenstein, I'm a tax manager here in the Grand Island office for Lutz. I would say probably 70% of what I work on is in the ag producer agribusiness space. So I work on the tax side, do tax returns, but I would say what fills my bucket is doing the consulting and kind of helping people figure out the issues that they might have and how we can help you in a more of a 5 to 10 year look rather than let's not pay any tax this year.
I'm Laura Trzynski. I am a Senior Director of Business Owner Advisory Services at FNBO. I am located in our North Platte branch, but I cover Kearney, Grand Island, North Platte, and I cover our ag customers kind of across the footprint. And so our group was formed about 5 years ago. We had a lot of customers that were wanting to start talking about the process of succession planning, and they just weren't sure where to start. And so we make it clear, we're not here to be your attorney, your accountant. We're really here to help our customers start getting organized and help engage those professionals and kind of keep the process moving, and then maybe deal with some of those items that might come up, the questions about the family conversation, some of those pieces. So that's what we'll talk about today.
Great. Thank you. So we've got a QR code on the screen for the people that are tech savvy, which isn't necessarily me either. But if you do, it's in your handouts as well. If you want to ask a question to the group, feel comfortable with that. If you'd rather submit the question anonymously or whatever from that perspective, you can also submit questions that way. Like Reagan said, we do have a couple of planned stops to go over some of those questions. Format will just be some panel discussions, topics for these four to speak through. If you have a burning question, you can obviously ask them once, or you can wait until that break at that point. We'll go ahead and get started with our first question, which is for the entire panel. So I'd like to get each one of your perspectives on who should be part of the Farm Families Advisory Team during a transition, and what role does each professional play? Don't everybody volunteer to go first. Whoever wants to get started.
I'll start from my perspective where I have tended to play, which is going to be different from the accountant. I'll let Tim Tyler talk from that perspective. Has been valuation, but it's not just valuation of the underlying asset, it's valuation of the business. And where I can take it is sometimes there's a discount of lack of marketability or discount of control. And so from a gifting scenario, if, let's just say you have $5 million of, land, machinery and equipment, and it's an LLC, and you want to gift that out, I can take some discounts on that. And so when you start thinking of transition, if gifting is part of the transition, gift and estate planning, that can be a really nice tool that the IRS allows us to take those discounts. So you're able to transition at maybe 75 cents on the dollar. So you can use exemptions from federal standpoint to kind of get that out of your estate, which, like I said, is a really big key if you have a taxable estate, or if you're trying to square up, maybe you have some life insurance with the other kids and you're trying to get the farming operation or whatever it might be into the hands of the operator. So that's where I would say I play a lot. And then, what role does every professional play? I always think about, we're going to have a bunch of advisors talk. There's probably one person, if not two people, that really have the ear of the business owner. And I think trying to figure out, put all that to place and figure out who can be the true quarterback to get it over the hump, that they're like, okay, I've heard it from every angle. What do you think? And it really, I think, kind of, that's important for that person to realize what role they play. And if they really are that quarterback, they have to do the best for the client. And sometimes it's, transitioning to someone else or transitioning it to the attorney to take it over the finish line. But trying to figure out where you play in all those advisors, I think, is most important.
Yeah, I mean, I think this panel is a great representation of advisors that should be involved. Sometimes I think I'm guilty, I'll raise my hand. Sometimes we forget to include the bankers until we're a little ways down the road, and then we say, oh shoot, how does this impact banking relationships? And so I think having the lenders and family bankers at the table from the start is important. Tyler and I have a couple mutual clients we've worked together where he's had relationship with them for a number of years, and it really helps me as an estate planner to step in and gather his advice about, here's what a tax picture looks like, and here's some ideas financially, what tools can we use legally. And so I think certainly accountants, lawyers, and bankers should all certainly be at the table, plus trusted family advisor. If one of those three happens to be the trusted family advisor, that's great, but could be an additional person there.
Yeah, absolutely. I mean, I think just like Spencer said, I mean, bring in the accountants and attorneys and bankers all together. I mean, and I think that sometimes people get sensitive about, because I mean, our fees do cost, but at the end of the day, what we can save by being on the same page rather than we're trying to play telephone through you on everything is a big bonus and a big benefit. So if we can all come to the table, I mean, even if it's one time a year, one time every 5 years, and you can put everything together, I think that's a big benefit where everybody's on the same page, where I'm not telling you to do something and Spencer says, well, I've known you for 10 years. Why would you do something like that? Because I can save you a little bit of tax money this year. That doesn't make sense.
Yeah, and I can't echo that enough as far as the importance of having everybody at the table. I mean, the number of times we've run into the accountant saying, well, they told me this, and the attorney saying, well, I understood it this way, and you're just getting a lot of different information. So having the whole team at the table, and I would agree this team. The only other person I would add is potentially a financial advisor, just because when you do run into that valuation piece, sometimes then playing out what does that look like for you financially. It's great to have a wonderful plan, but if that means that the person transitioning isn't going to be in a financial position to continue to be successful, we want to be aware of that as well. But I would agree, I echo, and I think, again, the importance of having everybody kind of at least once or twice come together and say, how does this all play together is really.
I think the only other one that I would add is maybe insurance. Maybe it's life insurance or property and casualty or health, whatever it might be. They can help facilitate some of the gaps within the planning. So that was one other one that I'm
gonna go off script, Reagan, but to expand on this question, something that I have an answer to, but I want to hear yours. So we've talked about who from the advisory side should be at the table. What do you feel like from a family side when you start to have these conversations? Who should be at the table and when, from that perspective, and what helps make that process go as smooth as possible? You don't all have to answer, but if anybody hasn't.
I think we talked about it. I think you basically hide it from everyone until the last.
Do not.
Don't bring anyone involved. That declare. No, I mean, it depends, and once again, not trying to steal anyone's thunder, but I think it depends on the situation, but I think be as transparent as possible. I think we're gonna echo that probably throughout the next 90 minutes is transparency, who are the true stakeholders, and at what point does it make sense to bring them in? You probably are talking constantly with your spouse, but then who's getting it transitioned to, when do you bring them in? But then is there other siblings that are not on the farm? Who do you bring them in? When the advisors, like, at some point, you probably want to bring everyone under the table. But there is time for all of that, but I would definitely say the more transparency the possible, because because I've seen it in my family, if you get to the point where, you have, the grandparents pass away or your parents pass away type of thing, and you're left with the siblings having to fight these battles that should have been fought 10 or 15, 20 years ago. It was more transparent. So that's my only one key takeaway.
Yeah, I usually tell our clients, family, in my experience that I've seen, that once in a while there's some outliers, but for the most part, family fights are driven by surprises. So if there are no surprises, you really diminish the chance you're gonna have a family.
And I think, well, I mean, the thing that I like working with farm families the most is, I mean, you're not just doing it because you are trying to get a paycheck one day. I mean, most people in the ag space are there because they love what they do, and they wake up every day and do it because they love what they do. And if you do that and you just ignore all this stuff and let your kids fight over it at the end of the day, I mean, did you really accomplish what you wanted to do? I mean, there was somebody you were building it for, because most people I work with aren't selfish. They're just building it for themselves. They have an idea. They want kind of a legacy to stay behind. And if you ignore this stuff during your life, and just imagine that your kids are going to all get along. I mean, I think all of us have been in the situations to know that that's not how it works out. So doing the legwork up front is, I mean, can pay a lot of dividends while you're here and when you're not.
Yeah, and I think what I see a lot is the hesitancy of having that bigger family meeting is people don't want it to turn into a discussion. And I think we were talking before, just because you involve people doesn't mean that you're asking everyone for their opinion. And I think to the extent that that's a barrier, I think it's still, hey, this is my plan. I just want to be open and honest about what the plan looks like. And so I think there's a way to clearly kind of communicate that I want you to be involved because I want you to understand. I certainly want to hear from you all. But that doesn't mean that you're giving up the ability to make those decisions. It just means that you're, inviting that conversation a little bit. So.
Thank you. If you only take a couple things away from this presentation, I mean, one of the most important things to me that I see go wrong is people put plans together and they're not transparent about it. And it's a lot different when mom and dad are in the room and say, this is what we want to have happen. Doesn't mean everybody's going to like what happens, because some people probably still won't. But from a longevity, from a family perspective, that conversation happening earlier versus a will being read, people being surprised, goes a long way in keeping your family relationships in place. So, all right, we'll go on to the next question. This one's for you, Spencer. What legal structures or documents do you most often see missing or outdated when farm families begin a transition, and what problems does that create later?
Sure. So I'll take a stab at this, but certainly want to hear from the panel thoughts as you review the work that the lawyers do. What do you see missing? Yes. So I think two things that I would say here. One is, and you'll hear me probably say this a couple of times throughout the presentation, walk before you run, and don't let perfect get in the way of good. So sometimes we have we have clients who maybe we've been talking to for a while, or families who say, well, we know we need to do something. Just keep kicking the can, because there's some question they don't want to answer. They either don't want to address what to do with off-farm, off-ranch heirs, a lot of times, or they're not sure how to do. What if I give child one this piece of ground and child two this piece, but I don't know if that's what I want to do. They just kick this can, and they just keep kicking it until they have the perfect plan. And they say, we'll get to perfect. And so what I am trying to impart is, don't let perfect get in the way of good. Let's get a good plan in place, and then we can turn good into perfect over time. But rather than keep kicking that. So I made a short list. I mean, to me, I think it is, get some base documents in place in case you die tomorrow. Or if you don't die, you're in a debilitating accident, right? So get some powers of attorney, get a simple will or trust agreement that says, if I'm gone tomorrow, here's where I want the assets to go. Okay, that doesn't mean you have to share that copy with everybody. Maybe we're not quite ready to involve the family in that whole decision, but at least there's a plan if you get hit by a truck tomorrow. So that would be number one. Number two would be, consider operational risks. So do you need an LLC, limited liability company, for high liability assets? Usually I think about things with wheels under them. Do you have semis going down the road? Do you have livestock that get out on the highway, cause an accident, etc.? And you have those things with substantial value in land. If the answers to those are yes, you might consider, encourage you to consider getting that separated. So again, if we've got a liability event, somebody gets killed tomorrow, we've protected a base asset over here. Revisit your buy-sell. So now we're working further down the path. This is not number one. This is number three, right? Then you might say, okay, well, we've checked all those boxes. Let's revisit any buy-sell agreements or operating agreements, bylaws that we have in place. They might have been written in 1985. Well, we're a long ways away from, more than most of us want to admit, from 1985, right? So let's revisit those. Let's see if they still reflect the current situation of our family, and make the updates that are needed. Well, I see a lot of times, is maybe a value has been fixed for that business, and the buy-sell agreement is fixed around a 1980s or 90s valuation that's 25 years old, and the value of the business has gone like this, but the documents still say we're going to use this number. That's ripe for causing fights among them. So those would be the three things I would say are sort of, 1, 2, 3. And then after you've checked those boxes, keep the conversation moving about more sophisticated planning. So then we can start involving, we would have partners involved in that, but you didn't hear me going on about taxes or estate taxes or gift taxes or any of that. It's off the table. Just the threshold questions are, if I have a debilitating accident or die tomorrow, what do I want to have?
I would say, well, the most important thing I think that I see is, like Spencer said, is people try to have the perfect plan. And it's like most of these plans, unless you're starting to do some sophisticated like gifts to trust or anything. I mean, if you change your idea tomorrow, you can change it tomorrow. It doesn't lock you into this plan forever. You have a lot of flexibility in a lot of that stuff.
And I think to that point is, I always think about it as it's a kind of a living, breathing document, and it should. As you change and as your situation changes, it probably needs to be revisited. Not that you have to actually physically change it, but you need to make sure that that aligns with what your situation is. I think about it, when I have young kids, yeah, I'm going to have it different now, but in a situation in 10, 15 years, they're out of the house, that looks differently. That plan should look differently now than it is then. So I was thinking about it as a living, breathing document. The only other thing that I would say that's come up recently in this last year, once again, from a valuation perspective, is the Conley case that if you have life insurance inside the business, that's owned life insurance. So you have two individuals and I have life insurance on them. They have life insurance on that person. And that's supposed to be the mechanism to buy them out. The Conley case says that's not the case anymore. That is just an asset of the business. And so if I have $5 million value and $1 million life insurance, now it's $6 million without any redemption liability coming off the table. It's now just $6 million. So I think about that. If there's a lot of buy sells out there, there's a lot of valuation, a lot of documents that are tied to, and this is supposed to be life insurance is supposed to be the mechanism to buy that out. That's not the case anymore. So once again, make sure these documents tie with tax law, with legal, which is why you have advisors to help you with this, but just revisit it. It's a living, breathing document from that perspective.
Another thing I would say, and I don't know, Spencer, I'm guessing you see this, where sometimes people have like the corporate documents that worked great when it was a husband and wife working in an entity, but when you start involving next generation, maybe those documents have not gotten updated to reflect that, hey, we need to be more conscious of the fact that there's multiple family members here and we probably need to kind of revisit this. And so that's one thing, you know, when I've seen customers said, oh, we've got to go back to your attorney and talk to them about, you know, now that there's other generations involved, probably some of this needs to be a little bit more extensive than it was when you all were, you know, husband and wife working together in the business.
Laura, when you're meeting with people, how often do you encourage them to go back and look at those documents, or is it?
All the time. I mean, it's a pretty, yeah. You know, what I see a lot is, I think in the agriculture space, specifically, it happens in every space, but I think because you're intermixing maybe family and you live on the property and you work there, I think sometimes that business piece of the actual like technical business part gets kind of pushed to the background. And so we always say that's something you should be reviewing with your attorney on a very regular basis. And they may tell you it looks great, but then at least you have the peace of mind that you've had that conversation again.
Okay. We'll go on to the next question. Ryan, how do farm families realistically fund the transition without putting too much strain on cash flow or the next generation?
And there's another question later on that I'm gonna kind of take from the buyer's perspective, but I'm gonna take this one from the seller's perspective. Or let's just say the parents or grandparents, or whoever's transitioning it. I would say first and foremost, anytime that we look at from an estate planning side of it is, you got to start with your personal financial balance sheet and just kind of put that together. Start one. What all assets do you own? Not just that farm that you're looking to transition, but the kind of the whole piece of it. Do you have liquid cash? Do you have investments? Do you have other business ventures? The reason that I say it that way is because that helps the equation on what you need out of this transition. If this has to be your nest egg to allow you in the next 20, 30 years to do the next phase in life of what you want to do as a couple or whatever it may be, that helps you figure out what your cash flow has to be. So I always think about it that way. You kind of have to first start with the basics, kind of like Spencer was saying with the legal side. You start with the basics. It's like, what do we all have? Like just compile everything, right? And start there. And then after that, you can move down the list and say, okay, do I need to maximize what I have out of the farm? If that's the case, then, okay, then we have to look at, is this even cash flowable? How much cash flow comes to this? And a lot of times if it's first generation, third generation, whatever it might be, we've accumulated a bunch of land. We've accumulated a bunch of machinery and equipment. But if we had to repurchase that today with how much cash flow is getting kicked off, it may or may not be realistic. And I think that's kind of where the question's getting to. How does that come in? Well, you might do seller notes. It might be a long-term lease. There might be a situation where Laura's team gets involved and maybe the bank can take on a portion and then you take on a portion of seller notes. But it all, to me, comes back to how much capital you need out of this as the one that's transitioning or in theory selling it or gifting it. And so I think about it from that perspective is not that we want to put a strain on the next generation. Absolutely not. But if we can't take care of our own cash flow, then are we doing an injustice by transferring it? Because in 10 years, if I need funds, or 15 years if I need funds, there isn't a way to go back. Like we're not transitioning it back. So I think you have to start there. You have to start, is there liquid funds as opposed to illiquid funds? So we're asset rich, but do we have the cash flow? So that's kind of the way that I would take that is you can realistically do, like I said, long-term notes, leases. You can do a situation where you do it in tranches. Maybe they buy the equipment and then maybe buy parcel of land, but there has to be enough cash flow to support that. And so I always think about it, if you have a banking relationship right now, no different than if you went and got your first home or a car, maybe you do something where you let them run the numbers for you and say, is this even an option? Is the bank even an option for us to be involved? And if it is, that's great. Now you have one option because you can always be the bank. But if you can bring someone else to help you front that, then you get your cash a little bit earlier and then you can kind of do it in different tranches. So that's kind of my initial thought process. I don't know if you guys have any other thoughts.
I think it's just important too. You see it a lot of times where you have kids that are on farm ranch and kids that are off. And if your goal is to have the kids that are on the farm ranch take it over, I mean, making sure that you set them up with the assets or cash flow to be able to take that over. And I mean, I think we would all agree that fair and equal aren't always the same answer. And these, especially in these, I mean, where you have a lot of wealth, but it's not like it's a cash flow, just business where you have cash sitting everywhere. So that's another piece of the transition that I think makes it harder. And I think it gives people paralysis sometimes of how do I make this fair or make it so everybody's all right with it? Well, the answer is it's not always fair. Fair isn't always the right answer. And that's where it's makes sense to have conversations with people that have done it before or people that are in the business of helping people through it.
I think what you're saying, Tyler, is fair is not necessarily 50-50, it might be 70-30.
Right. And being transparent goes back to that, right? We said we're gonna talk about it, being transparent, saying, this is the best way that we think that we can make sure that this transition to the next generation is this scenario or a couple scenarios. That doesn't mean it's fair.
The only other thing I would add potentially is to think about operational versus ownership, right? So to this question and taking Ryan's point, if we're addressing this from the senior generation who's passing on to the next. So likely if you've got a second or third generation on the farm, they're there because they enjoy the operational side, right? And enjoy it and you don't have them handcuffed to the farm, they would be off doing something else. And so finding a way to transition operationally, meaning are they picking the variety of corn that goes in the ground? Are they picking the vaccine that's given at branding? Are they, involved in the marketing of the grain and the livestock? Transitioning those decisions coupled with some leases and long-term commitments so that generation feels comfortable. I can invest in this place for the long haul, and maybe I'm not getting ground deeded over to me today, but I know that I can operate this place like I want to run it for 15 years, and it's mom and dad's plan that the ground eventually will come. That gives them some ability to grow and thrive in what they're enjoying doing, and some comfort that it's not going to get pulled out from under them, but also allows senior generation to maintain the income stream that might be needed, to your point, for retirement and traveling.
I mean, the only thing I would add, I think Brian did a great job of hitting on it, is I think the key word up there is realistic. And I think being honest about what's realistic and what isn't realistic. And if it's not, then you've got to go back to the drawing board. But I've seen people try to kind of fit a square peg into a round hole of like, this is what we want to do, so we're going to make this work. And then that doesn't allow for a lot of other success for future generations or for the transitioning generation. So I think just, again, being honest, transparent, and be realistic about what's going to work and work.
And I think one thing that Spencer brought up is important. So like when we talk about this stuff, I think succession planning and estate planning get thrown in the same bucket all the time. In my head, they're two separate things. Estate planning is where you talk to Spencer and you get the legal documents in the spots that you'd think they need to and where the assets want. Succession planning, I think, is really more so where you're giving your kids the swings at stuff while you're here, where you can let them screw up and get the opportunity to coach them through those issues, rather than someday you're not here and they're just guessing, well, I think this is maybe what mom or dad did, and I don't really know. So, I mean, it's hard, and I mean, nobody giving up control isn't easy by any means, but letting your kids have the opportunity to make mistakes while you can coach them through it, because I mean, most people sitting in here have made plenty of mistakes and learned from them. So, I mean, I worked with a farm family this summer. That guy was 62. And he's like, well, this is the first time I could really get a farm. So he's that late in his life and didn't really get a swing at it. And I'm just going where I think Dad said.
Tyler, you're the tax guy. So what tax consequences most often catch families off guard during farm transition, and how can early planning help reduce those surprises?
So I think there's a couple different angles to go on the tax consequences. Before the One Big Beautiful Bill, the federal estate tax was supposed to sunset at the end of 2025 and basically get cut in half. So married filing joint family, $14 million. Any net worth over that would have been taxed at approximately 40%. So it really doesn't take a lot of ground and equipment or cattle to get north of that. And so that got extended to 30 million indexed for inflation, which still, I mean, with land prices and cattle prices and equipment prices, I mean, it doesn't take a giant operation to be knocking on that door. And the tax rate on that is super high. And that's where I think it's really important, like Ryan said earlier, to having a personal balance sheet of knowing what your assets are and what a real fair market value of that is, rather than you kind of play this game with the accountant and this game with the banker that we don't make any money, but the banker wants to see all these assets. You kind of being realistic on that. The estate taxes can be a giant bite. And if you're north of that, I mean, you can really handcuff the next generation if you haven't done any planning. And that's where I like to pull in, I mean, the attorneys and valuation guys, because there's some different strategies that you can use as far as discounting while you're alive for lack of marketability, lack of control, stuff that Ryan's group gets into a lot. So if you're anywhere close to those numbers, I mean, if you're knocking on that $30 million range, is definitely time to start having that conversation. The other thing I would say on income tax, which, I mean, there's a lot of different strategies you can use as far as getting rid of income tax, especially with depreciation. It doesn't take a lot of equipment to get to some really big numbers. But if you're getting closer to the end of your career and maybe buying equipment and just writing it off to zero, and then you're going to sell it in 3 years isn't the right answer. Maybe slow down some depreciation, pay some more tax, because with the tax brackets, maybe let's be efficient and pay in the 22% bracket and paying 0, and then we go to sell our equipment and we're paying 37%. Or a lot of times you're deferring grain, so maybe you have all your grain and your equipment sale in 1 year, and makes sense to go in different years and stagger years as far as some of those sales go.
I don't have anything from taxes, but the mistake I see is people not wanting to engage their accountant or their accounting firm earlier often enough, where it's kind of, well, we think we got that figured out, and it's a lot easier to have that conversation 5 years before you want to do something than it is when you want to do something, the next 6 months. So I just think making sure, again, that you're having those conversations with your advisors is really important.
I mean, it makes all of our jobs a lot easier if we know what your goals are, so we can kind of think about the next 5 years rather than, I mean, I can make it so you don't pay tax this year, but that doesn't mean that's the right answer for you next year or in the next 5 years.
I think
I've had the chance to work with a couple of families where they're transitioning their farm, meaning they're stepping out of operation. So they've been playing the tax game, pay down, prepay, stock up grain. And so in their final year of farming, the couple that are coming to mind here were also charitably inclined. And so we were able to use some charitable remainder trust strategies so that they could get that grain in a tax deferred situation, I'll call it. They receive a revenue stream off of that for a period of time, and then ultimately the balance goes to charity. And so that's a very specific example, and the client has to be charitably inclined and want to do that sort of thing. But the root of that point here is, I think it's good to get the advisors involved early rather than come to Tyler's office and say, well, I just sold all my corn and now what do I do with it? Right.
So for that charitable trust, you mentioned grain, can you put equipment sales into that thing? Can you do land sales, everything?
Equipment and grain, certainly, because in this case, they had been depreciated. They put depreciated equipment, so basically zero basis equipment and zero basis grain, just prepaid. And then we work through the table that there's tables to figure out what is their revenue stream off of this. Now that would be taxable revenue to them, but
So at a lesser amount than maybe if they took the whole thing at once.
exactly.
Okay.
Right. And then ultimately the balance goes to charity. So it's usually a term of years or for their lifetime. Yeah.
Okay. Thank you.
that's the only two other points that I'd throw this, because we talked about control and different things. What I've seen is, depending on the structure, is kind of doing two classes of ownership, maybe a class A, class B type of thing, to where you can still own that class A and you own all the control, you own all the voting, but maybe it's a situation where we've told for a couple of years, you're going to be a part of this, you're going to be a part of this, but they keep saying, well, when am I going to get some ownership? When am I going to get? You can give them some kind of non-controlling ownership or non-voting ownership to shore up kind of, yes, you are gonna be the next generation, and this is the way to go about it. So you don't have to give away control if you don't want to, put it away to, maybe it's a gifting strategy or they buy in, but you figure out what that non-controlling units are. The other thing is to the exact point that they're talking about is, what's a sale look like? What do I actually end up in my pocket type of thing? So same thing, I keep going back to cash flow. If we need money in the future, what does this look like? We have this asset, we have this personal balance sheet, but if I were to sell any of these, what does it end up in my pocket? And using kind of the tax, I would say gain calc, you want to look at it that way. What am I going to have to pay Uncle Sam? And then when it ends up in my pocket, will allow you to probably model out what the next phase of life looks like. So there's kind of two extra things that's wrong.
All right, Laura, I'm sure you have some good stories for this one. But from your experience, what are the most common family conflicts that arise during farm transitions, and what could have prevented?
I feel like we've already covered this, so we can go back to that again. So, I think there are kind of, two categories of this. So I think there's the on and off farm family conflict, and then the on farm between operator family conflict. I would say both of those, what I see most often is rooted in misunderstanding. So again, it gets back to that communication piece. But when it comes to kind of on and off farm, it's not only the succession plan, the inheritance, I even see it down to things like childcare or an assumption that there's favoritism because somebody's staying on the farm, or, are they going to get all the family heirlooms? So it's not just the technical and financial aspect of who's getting the farm. It's then there's that perception sometimes that person is somehow the favorite child and you like their children more, and you go to more basketball games. And so, for that piece, obviously what we've talked about as far as being transparent about your plan in general, but also really making a good effort to demonstrate the importance of those non-family non-farm family members. So can you take a little time to go visit those children if they don't live somewhere? Can you make sure that you're setting aside, one of the worst arguments I've seen, and this was years ago, but was over a family Bible. Can you make sure that you're thinking about those aspects and maybe the emotional pain? Because a lot of times what I've seen is that the non-farming family members, they're fine with some of this. They know they're not farming, but the real estate, but it's that the house maybe goes with it, and that you're, again, spending your time. So really being cognizant of making sure that those other family members feel valued. When you do have that conversation after Thanksgiving is not the time to have it. Christmas Eve is not the time to have it. Really setting aside a time for a family meeting to talk about the nucleus of the family and how it maybe relates to the farming operation, but also how the family itself is important too, and just communicating again that piece. When it comes to on-farm, I see a lot of role clarity creates a lot of issues sometimes. And then the second one I see the most is maybe the generations have different ideas about the future of the operation and what that looks like. So again, I think one thing is making sure you're talking with your attorney, your accountant. Are we updated as far as maybe, I work with a lot of families who don't even really have any documents, not estate planning documents, but any kind of agreement as far as, the corporation goes or the LLC or whatever the case may be. I'm a big proponent of job descriptions on family farms. I think even if you don't have them as like set in stone, I think it's really helpful when you start engaging quite a few family members to say, okay, what do you do? What do you like to do? What do you think your responsibilities are? Have other members of the family farming operation have that same exercise. And that really allows you to see both the gaps and also clarify, sometimes if somebody handles the livestock and somebody handles the farming, there's this perception that maybe one of the jobs is harder than the other or whatever that may be. And so it really opens the door for that conversation. And again, treating it, even if it is dad and, two children or whatever, the mom and two children, making sure you're still having a business meeting to separate that, hey, we still have to have this conversation, operate it like a business. So that's kind of what I generally see as kind of the biggest issues is just being aware that if you don't communicate, there will be misunderstanding that you could probably clear up fairly easily if you just have that conversation.
Or do you say on some of those like family meetings? I mean, do you have tell families to have more formal meetings.
I do, and I always advocate if you need to engage a third party, that engage a third party to make it be more of a structure. This is what we're going to talk about, and it's not just everybody kind of just throwing their 2 cents in. We even advocate for things like a family values workshop. Like, let's say what is important to us as a family. That may pertain to the operation, may not, but that really allows those relationships to flourish outside of maybe some of that other, technical piece.
Yeah, and I'll piggyback on that to your point, not just in, I'd say the family farms, but our other transitions is getting back to what I said, the quarterback. Who really has the ear of whoever's transitioning, right? Could be the accountant, the lawyer, the banker. That might be the person to help run those, right? And so if you do have a situation, maybe the accountant does everyone's taxes, right? So maybe they have already a nice, in, so to speak, and then it can be a little bit more professional, and it's not so much, we bring up the fights that happened 25 years ago when it doesn't matter. We're keeping it professional, keeping it to the purpose, right? An agenda itinerary. The only other thing that I would add to the conflict side of it is, it's the soft issues that need to be addressed before you get to the hard issues. So if there is those underlying fights, you got to get ahead of those quickly. So if there is, you're talking about the farming and this, this brother and this brother don't like each other because of this. Well, we need to vet that out before we become business partners, right? You don't have to like each other every time, but you got to be respectful and you got to vet that stuff out, because if not, that's the underlying current. When you don't have the mediator, mom and dad around, then it's only going to get worse. So that's my only that I've seen a conflict that should have been probably preventable.
Do we have any questions, Reagan, or not? Anybody in the room have any questions they want to ask? Or you want to listen to them talk? You.
I mean, you guys had to have had some experiences where siblings have butted heads or fought tremendously, and then when mom and dad are gone, it's like you said, it's just like they just go at it. And at that standpoint, is it just like, hey, this is what it is now, and you guys need to figure it out, or is it you guys stay involved at that point to try and clean things up, or is it? I guess how does that work?
So the situation I was brought up is, I think it probably needed to be split beforehand, but it was brushed under the rug. It'll be fine, right? Oh, they always fight. It's fine. It's fine. It really was about 2 years afterwards, and it all blew up, and they don't talk to each other anymore. And so they had to go into a situation. They liquidated out. It was a C corp, so it was a bad answer, bad tax situation. It just was a bad all the way around. And I think if you would have gone back 10 or 15 years when we were helping plan, the parents would have never wanted it that way. And then they said, okay, how do we do this the right way? So that's where I go back to transparency, bringing the right people and getting those fights laid on the table, right? It doesn't have to be where we're going to sing Kumbaya at the end of this, but you have to lay it on the table. And if you can't get together now, then there's no way we're going to get to there when the mediator isn't. And so that's my own thing is have that conversation. There may not be an answer to it other than you got to go your separate ways. But if we can, then get ahead of it. Don't keep it together. But
I think that's where being realistic goes to. I mean,
yeah,
it's going to be fine. Okay, well, what's going to make it fine, or what's not going to make it fine, or what do we need to do to make it fine? So, just being honest that just saying it'll be okay is not a realistic response. When your children haven't gotten along for 25 years, they're not going to all of a sudden love each other when they're operating without you there.
And so
Go ahead.
no, I think it's kind of for you, Spencer, too, as far as structuring. I mean, sometimes I've seen where maybe brothers farm together, but they have their own operations and they share resources or buy equipment 50-50. But this one brother likes spending more money than the other brother, and you didn't basically tie them together in a legal entity. So, I mean, maybe that's kind of where you're going, but if you have some more to.
Well, for the last slide, the note that I wrote down was what drives a lot of these conflicts is mom and dad kicking the can. And so to your question, do we stay involved? I would say we do. I mean, I've got 3 or so right now where we're kind of just mediating sibling disputes, trying to get the ball moving to a spot that everybody
Yeah.
can kind of unwind a bit. But all 3 of those situations that I'm thinking of were because mom and dad didn't want to make hard decisions. So they just said, we're going to give everybody shares of the corporation and let them run this thing together with no account for their diversity of life situations and perspectives and all of that. The one family, to their credit, follows the formalities very well. I mean, they set aside time. They have a family corporate meeting, which I think kudos to them for doing that. The issue is, in my opinion, mom and dad should have made some tough decisions to say, these assets are going to you, these assets are going to you. Here's a vision and a plan for moving this forward, as opposed to, congratulations, you're all 20% shareholders, figure it out.
Yeah.
Right.
Absolutely.
And I think
And one more point to Tyler's point about tying people together. Every attorney is different, every family is different, the situations are specific. I try, when counseling clients, not to end up with undivided interests in real estate particularly. So, because in my opinion, that's just kicking the can. Yes, we're just kicking the can. And so let's figure out a structure. Is that an LLC, a trust? What is it that puts some plan around this to say, we've got some flexibility, but generally here's the vision about what's going to happen with that asset, rather than, congratulations, you're all third owners or 20% owners in this undivided piece. Up to you to figure it out. I mean, that's mom and dad kicking the can, right?
Yeah, and legal documents are silent to how I get bought out, when I
Right.
get bought out, and
Yeah.
not back to the impasse,
Exactly.
right? So.
And so if we're gonna do this, then, the next step is, okay, when one person wants out, what's the process?
I have a customer that does that, and that has been tremendously, invaluable to keep everything together, to keep the ground together, to where it's a set rate, set amortization. If you want out, here's how it goes. And that's just been, with the fights or whatever it may have been, that has been huge. So I've told everybody that has a ton of land, until I'm blue in the face, you've got to look at setting it up like this, because that has just quashed so many problems and just taking care of it, so.
They have another question come through. One was, under what circumstances do we need a will versus a trust? Should land always be in a trust?
Good question. And probably should give the disclaimer that if you want legal advice, contact. It's funny, I have had clients, come to me and say things like, we're not rich enough for a trust, or we don't have enough money for a trust, and when is this valuable? Generally, I ask every client, first question is, do you have minor children? The answer to that is yes. Got minor kids, we're gonna have to have a probate to get guardian appointed for your minor kids. So this goes clear back to the beginning of the conversation when Ryan said, these are not set it and forget it things, right? So when you've got newborn kids at home, you need wills to name guardians. Over 19 years, your net worth is gonna grow, your life is gonna change, et cetera. Your plans need to be revisited. So one is, do you have minor kids? You definitely need a will to name guardians there. And then step 2 is, do you have over $100,000 of value equity in real estate? And if the answer to that is yes, so the reason I ask that question is statute allows us to move 100,000 without probate. So if your kids are over 19 and you've got more than 100,000 in equity, I'm usually encouraging trust-based planning so that we can avoid probate. Probate is a process the statute lays out and says, here's the steps you follow to administer an estate. By using trust-based planning, you can preserve some privacy, some flexibility within the family, timelines, a number of things that make administration much easier than the probate process, which is generally why we try to avoid it. So.
Another one was, what suggestions do you have for non-farm children to get the on-farm parents and kids to begin having these discussions sooner rather than later?
That's a tough one because you can't force the conversation, and if people are being forced to have a conversation they don't want to have. I think all you can do is really communicate to whoever is in control at that point. Generally, it's obviously the generation, typically the parents, the importance of this to you. But I see that a lot of, I want my family to have this conversation, but I just can't make them. And it's really hard if people won't agree to come to the table. I think what I've seen is I've seen people sit down and, write letters and say, this is why this is important that we have this conversation. I've seen people try to, I think to Ryan's point, is there an advisor that maybe that family member is particularly inclined to listen to that will say, hey, you need to have this conversation. But I think really just continuing to reiterate that this is why this is important. This is what could happen if we don't have these conversations, and just continuing to, I don't want to say nag, but sometimes that's what it takes. So I like to use the phrase pleasantly persistent. But I mean, that's a hard one because you can't force people to have a conversation if they don't want to have it. But I think just making it clear why it's a priority is the best thing you can do. I don't know if you have any other
I'd say
ideas.
sign them up for this.
Yeah, exactly. Yeah.
No,
Lots of aggressive ways to go about it.
I just sent them a bunch of
Well,
accidents and mortality,
Yeah, exactly.
mortality rates and everything.
Yeah.
No, you're fighting an uphill battle. If they're not willing to have the conversation, even having the meeting, but what not having a productive conversation, you may not still get anywhere, right? So, I think it comes back to being as positive as possible and saying, hey, we want to get ahead of this. I think this is my fear being not on the farm. This is my fear that this is going to happen. This is my fear that's going to happen. And relaying those concerns, hopefully we'll get the parents at least considering it. Because we don't know what our timeline is. We might think we got 50 years and it might not be. So the kicking it down the road is not a plan. That doesn't work.
And there's a huge readiness component to this. I mean,
100%.
I think we've all probably had people that have come into our office, said, I want to do this. And then you call and you email and you try calling again, and it's just, you're not at that point. And I think that's the other piece, is just understanding it's an emotional topic, it's a heavy topic, and like, are there baby steps we can maybe take to make it a little bit easier to get to that point?
And I'll just piggyback one more time on Tyler's. Estate planning is not succession planning. And I think those are two things. Estate planning is that mortality conversation. That is not fun. No one wants to have it. No one does. Succession planning is transition of the business in an orderly way that makes the key stakeholders feel like they have an anchor to the business. That's how you transition first, third, fourth generation. How you keep a farm going is succession planning. Estate planning is a part of that and can be, but that's a totally different objective.
No, I was just gonna make a morbid comment and say that there's a readiness factor to it, but the good Lord doesn't operate on our timelines, right? So that was to double down on my point earlier about don't let perfect get in the way of good. Get a good plan and make it perfect on the readiness factor.
The other thing, just real quick, is there's like one piece of it that they might be willing to do. So if they're not willing to like tackle it, would they be willing to just get their personal financial statement like updated and maybe let where a couple things are? Or just like sometimes if you could just get a little bit of momentum, that's helpful in getting that ball rolling as well.
And maybe if you can find an angle, like what do they not want to do? Not want to pay the government taxes? Okay, come in for that, right? I mean, ultimately this becomes more expensive and a headache if it ends up in probate. It is harder and it's worse on the executors, it's worse on the emotions, everything's worse if it goes through probate. And I'm not a lawyer.
I mean, I just think of it a lot of times as like, you spent most of your life refereeing your kids from the time they were little. Like, why would you give up at the end of your life when you have the assets that you're passing down? I mean, really, that's what they're going to end up fighting for. And I've had this conversation with my dad's a small contractor, and I told my sisters I don't want my dad's rusty hammer so they can have that. But I mean,
You want the polished?
no, his bales of copper wire and that, but they can have all that too. But I mean, I enjoy going to Christmas with my family and my in-laws, and I've had the conversation because I have unfortunately have to deal with all these families that fight all the time. It's like, I don't really care. I mean, I think everybody likes each other enough and we have a great time when we're together. Like, none of this stuff is worth fighting for. So let's all try to get on the same page and make sure everybody's got a little bit of a runway and we can figure it all out. And I mean, I don't know. I just always have trouble is like you put all your life into raising your kids and putting them in a position to be successful for their life. And then if you don't do this piece of it, which is hard, nobody wants to talk about when they're going to be gone. But if you give up on that, I mean, you lived all your life to just start the fight at the end.
Got any more?
There's one more. In placing farm assets in a charitable remainder trust, what percentage of the earnings or asset value goes to the person placing assets in the trust? How much must go to the charity?
Great question that I don't know the answer to off the top of my head. There's rules and regulations on it. Depends on the number of years and the schedule. So you would really need to get with an accountant or a lawyer to run those tables and figure it out. There is a minimum threshold that says this percentage, which for sake of today's conversation, let's say is around 5%. Okay, so at least 5 to 10% of that needs to go to the charity at the end. Essentially, what it does is converts your low basis assets to similar to an IRA, right? So you're dumping a big chunk in where you're not recognizing tax on the sale, but you're drawing that out over a period of years and paying tax as it comes out. Ultimately, at the end of that term or your life, however it's set up, then the balance goes to charity.
Is that structure hard and fixed as far as like, if you do that charitable trust, it's a 5-year deal, it's a 10-year deal, or is it just depend on the situation, how big everything is?
It's either a term of years, which there's a cap on, again, I believe it's 15, but
Okay.
I'm disclaiming that also. I believe it's 15 years is the cap if you do term of years, or you use a lifetime, at which point you're using IRS mortality tables to figure out what the per year percentage, just again, like an IRA where you got to take a certain percent out.
Okay, thank you.
20 years is the,
20
20 years is the
Okay,
max.
thank you. Thank you.
Maybe Kurt would bail you out.
Yeah.
You're doing great. And I'm not here to get legal.
Any more, Reagan?
What else?
Anybody in the room have any questions? The people online are listening.
Just don't forget, it is kind of a miserable ordeal to go through succession planning. Not the succession, the estate problem.
Yes.
It's easy to make money. It's because it's easy to set the goals where you want her to be when you're 65 years old or whatever. Easy to make money and it's fun doing it. This is miserable. And then you think you got it halfway right. And if you're still decent at making money and you just doubled it in 7 years, and then you're screwed again. So whatever, it isn't easy.
It's not, and that's why you gotta just give yourself a long runway, because you get fatigued, right? If you don't give yourself enough runway, you can get fatigue on this for sure. Which goes back to Laura's point when you call and you're like, hey, are you ready? And like, I was. But now I'm back in because you're still running a company, you're still running a business, you're still running a farm, right? So to take that time away and it's a commitment for sure.
It's also, I was gonna say, it's not lost on me as an advisor that a lot of clients who are successful that we talk with, they've spent their whole life earning this, and we're telling them the best thing they can do is give it all away, right? So, I mean, that's not lost on me at least either.
Yeah, if you're gonna give the government 40%, but if I'm good enough to make, double it in 7 years, that's better than they're getting a better return there. And if I give it to the government, so that maybe it won't happen forever, but the planning's tough. You're talking about your own demise too.
Well, that's the hardest part about it. I mean, that's not the fun part. I mean, going out and putting your head down and making money is the fun part.
Yeah.
I had a question on SCPs or IRAs. When you get to a certain spot and you got all this cash, non-taxed cash stuck over here in these accounts, when you pass, is that all taxable? Can you I'm thinking about taking a certain percentage out every year and paying the taxes is, you know, working with my tax consultant, you know, how much can I take out this year and not get killed with the tax? Is that something anybody has ideas on?
Yeah, so I think, I mean, there's a lot of different ways you can tackle that stuff. I mean, so there's like Roth IRAs. I mean, there's some strategies you can use as far as rolling some of those monies that haven't been taxed and taxing them at lower rates, and then they can grow tax free. The next generation has a lot more flexibility than they do with a traditional IRA or a SEP.
So when, is there a limitation on when you can do that, an age limitation? Take, or take it out of the SCP, pay the taxes, put it in a Roth? Is there time limitations on that?
Jerry, you know those off the.
I don't believe there is. I mean, when people ask about IRAs, I mean, the first comment I always make is it's an awful asset to inherit a traditional IRA because there is no basis step up.
Right.
You've got a 10-year window when you got to take it out, but you've got 10 years to do it. So depending on what your heir's income is, maybe they can get it out of the lower rate. If someone's charitably inclined and we're looking at a balance sheet and they want to leave something to charity, that's one of the better assets to do that with because it doesn't come with a basis step up or a tax preference tied to it. I have a lot of people that are doing what you're talking about, where especially if we got a down year from an ag perspective, and we can roll money out at 20%, whether that's trying to get it into a Roth or just putting it into a taxable account that'll get a basis step up. That's a good strategy to deploy at that point in time. I mean, it's you get a great tax deduction when that money goes in. The market's done so well that now you've got this big asset sitting over here. You're 75 years old. Now you got to take $500,000 out of the thing and pay tax on it. It's not a great situation to be in if you built up a lot of money inside of one. So
do they tax that, what you take out of that IRA the same as your
it's ordinary income. So it's
ordinary income? So if you lose, I lost $100,000 this year.
Yeah.
Take that and not pay taxes on it? And,
I'll give the same caveat that
well,
but
is
yeah,
that possible?
generally
Can I take
speaking,
that out, put it in a,
generally speaking, your active business.
put it in my taxes and, then put it in a Roth? Is that
Yeah.
possible?
It's possible.
Thank you.
All right. We've kind of touched on this one, and I think we can be brief on it, but it'd be nice to hear for farm families who are planning, feeling overwhelmed, don't want to have some of these conversations. What's the one thing that you all think, if everybody walks away from here and does one thing in the next 6 to 12 months, what's the most important to do?
My thing is just that personal financial balance sheet, figuring out what you have, right? That's the one thing you can control without bringing anyone else in. You don't want to, just how big is your net worth truly? That would be my one first start in 6 months.
Walk before you run. Don't let perfect get away.
I like Ryan. I mean, a lot of times when I run through this exercise with clients of putting your personal balance sheet together, like, well, I see that you have income from this, but it's not on your balance sheet. So, I mean, it takes a while to put together that personal balance sheet, especially if it's something that you don't maybe do annually, or maybe gives you some time to think through all your assets and gives you some time to pay on something or get some income from something. So I think that's a really big one.
Yeah, and I would agree with that, just knowing what you have. The other thing is sometimes it takes a while to get into advisors, and I'm not saying you need to meet with any advisors, but I have some people who don't have an attorney or don't have an accountant and really starting to think about who would be on that advisor team. Are they taking new clients or customers? Would I have availability to engage them when I'm at that point? Just so that when you are ready, you can maybe have that team in place.
And I think using these people like consultants and not just the tax guy that you talk to one time a year and get your tax return done. Give them a little runway. Give them, I mean, here's my goals for the next 5 or 10 years rather than, hey, here's my stuff. Can you get my tax return done? All right, see you next year. I mean, a lot of people use agronomists or nutritionists or something like that as a consultant. You talk to them multiple times. Like, I see the professional services kind of the same way. Like, it's healthy for your business to use that. You're trying to make money by using those people. I mean, that's what I think I can do. If I wasn't in the business of trying to help you make money, then I guess I wouldn't like waking up at if I just had to come here and sit and do tax returns, I'd find something else to do, so that's not that exciting.
You do it well. All right, how can tools like LLCs, operating agreements, buy-sell agreements protect both on-farm and off-farm? I think we've covered some of this, Spencer, but if you have more insights you want to share.
One note I'll make on the LLCs, and I sort of hit on this at a high level, but I tell our clients that if you've got land ownership and operational assets, an LLC is the cheapest insurance you'll ever buy, right? So sometimes people will say, well, gosh, I don't want to pay you to set that up, or I don't want to maintain it, or if I get multiple people, you know, if I put me and my spouse on here, or me and a child, now I got to pay these guys to prepare a tax return for it, and I don't want to do that. So weigh those expenses versus a potential liability event, right? If you or a employee or a child is driving your semi down the road and gets in an accident, what does that cost your operation? Okay. Compare that to what we're going to charge you to service the thing, right? So I would say LLCs are the cheapest insurance you'll ever buy if respected and respect the formalities, treat them like their own business. The buy-sell agreements, I think, are super important, especially if you've got co-ownership in any asset, right? So to Tyler's point earlier, are we going to give each operator their own entity and let them work together on things and forward but separately, or are we going to tie them together in a single entity, whether that's operating or land ownership? And in that case, super important to give people the opportunity to get out. So whether it's forced or voluntary, what does that, at least we've got a plan for what does this going to look like.
Can you fix that number, or is it market based?
You can do, there's a number of tools you can use. These things are all tools in the toolbox, right? I hesitate to fix a number because of what happened, what I was talking about earlier, that we come across these buy-sell provisions that had a number fixed in the late 80s or early 90s, and that is so far from market-based now that it's ripe for fighting. So you can certainly tie them to discounts, and whether the documents say get Ryan's team involved and let him calculate what the discount should be, and that's our number, or whether they say go get a real estate opinion or an appraiser and start here and then discount this percent. There's lots of tools. I always encourage people to tie it to something that floats up and down rather than just say this number is fixed.
Well, like a depreciable value on a truck,
Mm-hmm.
you know, or a combine, you know, on the market, it might be worth this much, but if you put it on a sale, it might be worth this much. Can you give some sort of idea on how much you gave for it, how much you depreciated?
Well, yes. I mean, sometimes documents use the term book value, which we would write book value and give a definition, which usually says call these guys and see what is recorded on your books at. The challenge there is if you bought that semi for 100,000, but you're carrying it on your books at 20,000 or 0 or whatever, that can create some issues that you just got to get in the specifics of, you know.
And I'll come at it from a valuation perspective. Not that you have to look at it this way, but the IRS will look at it as fair market value. Mm-hmm. Everything is going to be fair market value. What can I sell this for? Not what your agreements say. It's great. You guys signed it. You guys shook hands. The IRS is going to look at it differently. So you want it somewhat close. This is not going to be perfect. I'm not saying you can't give some sweat equity or bring that down, but like it should be somewhat close to market within reality. There was a court case up in Northeast Nebraska that a guy within my department went up into the valuation, and there was talk about it in 1985. They signed the agreements. This was the book value. We're going to sign everything as this unit that they just, but within that, there was a provision that every year they were supposed to do a certificate of value. They're supposed to look at it every year. Well, they had bought out three family members on that price over 20-year span. But then someone got divorced And they said, no, I want it my fair market value. Ended up in court and the side won with the fair market value. So my point is the agreements are extremely important, but try to keep them somewhat close to fair market value, because if not, it could get challenged in some sort of litigation down the road, estate, and in-law, whatever it might be. That's my only 2 cents. Once again, I'm not a lawyer.
And the agreement's not the only tool in the toolbox, right? So if you let the value float, you might need additional tools to support that. So you don't just have your ratchet, you've got the socket that goes on. So if the value keeps floating up, you might need additional life insurance coverage. You might need to talk about gifting strategies, about how do we start moving this a little bit at a time. There's other, it's a combination of the tools in the toolbox to get you where you need to be.
Spencer, what do you do in that case? I mean, I know I've seen agreements where when we talk about a divorce or something where there may be reasons where the value gets discounted from the fair market value because the owner does something that's frowned upon by the LLC or detrimental to the LLC.
Yeah, I'll probably kick that to Ryan to talk about how he looks at it. But, I'm usually just having those conversations with people to say, here are the events that happen in the course of a person's life, or could happen in the course of a person's life. What are we going to account for here? But in terms of actually coming up with the number, I'll let you talk to that.
I would say that there's no perfect number, but I do see in agreements that there would be a significant discount if you've harmed the business in any way, right? If there's some fraud or something like that, because you can't equate what that means in the marketplace, right? If you're a business and there's some fraud or something that happens, or there's a felony and you're part of this, there is now a perception in the public that you've impacted the business. And so I think that is precedent to take a higher discount for buying that person out. But how you equate to that, I don't think anyone, IRS or anyone, could actually come and say, you're doing a buy sell at 25%, this is now 40. But I think they kind of let those slide and say, yeah, there's probably some detriment to that. But I've seen that for sure. And those tend to work.
Ryan, what financial red flags tell you a transition plan looks good on paper, but might not work in real life? It's cash flow, debt, operating, all that.
So this is where I was taking the first question as a seller. I'm going to take this from the buyer's perspective, or the one that's in theory getting the farm. A lot of times, if you just look at, say, a tax return or something along those lines, not everything may be truly factored in there, right? Is there truly a fair market salary for that individual to take this on? Is there should there be some health insurance and life insurance? What does it look like when we talk about on-farm, to now take this over? And what needs do they need? Not that you have to change your plans, but what does it really need from the buyer's perspective? What's working capital? Are we buying it on 3 really good years and the run's up, but all of a sudden it comes down? Can they get working capital? Because if I can't get to that bank, I go back to that. If the bank's not willing to finance it, or the assets are too expensive, and the bank just says, hey, I can give you this, but I can't give you this. Are you setting them up for success if I sell it way at this high price, when it should be some sort of factor in maybe a 3 or 4 or 5 year smoothing process, or a 10-year process? What's the cycle really look like? So I look at it that working capital is a big thing. Just because we look at the yields last year, is that fair? Prices, once again, if we're on the high side or low side, I always want to look at it from the buying perspective, because if the buyer can't, or if we're doing a buying scenario, it's not gifted, can they even make the payments over 1 or 2 or 3 or 4 or 5 or 10 years? If they can't, then the succession plan falls apart pretty quickly. Because if you've done transition and you're expecting that payment every month or every year to do what you want to do in your phase in retirement, if they can't make those payments, now we've just saddled them. And I keep thinking about, is this a blessing or a curse? And if this is a curse, then it becomes a bigger issue. And then there's the last thing that I think about is, once again, we talk about all the people, all the stakeholders involved. If you don't truly transition to that individual, to your point, pick the things, farm the way you want to. If you're always over top of it because you're the bank, and you've never really transitioned. So it sounds nice. Oh, yep, I've retired and I've get it up, but I'm still holding the note. So, oh, are you sure you really want to do that? I don't know if I do that. And so now you're putting doubt in their mind to that point. It's not until 62 that you're actually able to farm the way you want. So it's not just a financial red flag, but if there's the soft issues that I keep going back to is, are you allowing them to truly transition and take that over? And if not, then you might be setting them up for more headaches than might be a blessing at the end of the day. So I took one from the sellers, I took this from the buyer's perspective. And so think about it as well after you get your financial balance sheet and all that stuff, cash flow. It might cash flow, but make sure that all the expenses are included in it. Make sure that the transition is fair to them. Because let's be honest, there's going to be perception if there's off family member, they're already going to be throwing arrows at the person that's on, you know. Don't allow that to come from you as well.
And I think too, I mean, as far as that goes, I mean, we talked about, you know, how you vaccinate the calves, what cornea plant, but I mean, introducing the next generation to the bankers and your team that can help when you're, I guess, eventually gone, for lack of a better way to say it, is, I think, really important as well. So, because I mean, I always feel like I'm kind of hopefully the bridge or can relay what the previous generation wanted to the next generation and kind of help them get going, because it's a terrible time of life. I mean, when the new estate eventually occurs, I mean, it's hard for everybody, and hopefully that you built a team that can help everybody through it.
Right, Tyler, we got 10 minutes and Laura has a question, so do you. So what should farm families understand about gifting assets, estate tax basis when transitioning land, equipment, and the operating?
Yeah, I think I'll be real quick on this because it's something you can talk forever. But I mean, I think it's just be intentional and talk to your advisors about what makes sense as far as what makes sense to gift and what makes sense for the next generation to inherit. Because there's a lot of different things that play into estate taxes and what assets you maybe want out of your estate and tools that you can use that way. And your cash flow needs when you're slowing down, retiring, and but if you have issues with that or questions, talk to your advisor.
I think this is actually a pretty good question, so you've got some time to talk, but how do you help families balance being fair to all heirs with keeping the farm financially sustainable for those who will continue?
Well, far be it from me to keep people from happy hour, so you know, the first thing I would say if you're thinking about this is give yourself some grace. You're doing your best. I think the fact that you're thinking about it should go a lot, because as has been said multiple times, there's not necessarily a way to do this that's going to make everybody happy. And so some of the best advice I got when I starting kind of in this realm years ago was people will create scenarios if they don't know the why. And so I think we've talked about the communicating, but you know, some of the most extreme scenarios I've seen are literally people assume if you don't explain to them what's going to happen, it's, do they love me less? Did I do something to upset them? And if you can just have the conversation of, I am doing my absolute best for this family. I appreciate you all. I love you all. And I'm trying. I think that goes a long way. I know that doesn't help from the technical standpoint, but I do think give yourself a break, because it's such a unique aspect when you've got an asset that you're most likely not going to be able to offset with any sort of, you know, personal funds. I mean, that's just the reality, most likely. So I say, you know, keep in mind that it's a business asset, and it's reasonable that land and farming assets go to the person that's going to be running the farming. Then, from a technical standpoint, as we've said, can you make sure you're updated as far as your personal financial statement? What else do you have? And then when you go into your advisors to have the conversation of how can I do something to balance this out for my other family members, it's a lot easier to have that conversation. I think there are, you know, as Spencer said, a lot of tools in the toolbox to help at least alleviate some of that, but making sure you know what you're working with. I had people that, you know, they had an annuity they kind of forgot about until we got into this exercise. And so my team actually has, you know, we recommend kind of a checklist, not just, hey, let's do your personal financial statement, but kind of a checklist of, do you have any of this asset? Do you have any of that asset? Just to be thinking about what might be out there to kind of help offset that. And then I think, you know, again, regular meetings to talk about why you're doing it, what you're doing. And look, here's the deal, to keep the farm going. I think sometimes if people aren't on the farm, they don't understand. It's not possible to break off a little piece of the farm for the person that's not farming it. It's just not realistic. And I think sometimes people just don't understand that. So just kind of reiterate that having the communication, talking about it, being organized about what you have, using your advisor team to say, what can I possibly do here? Again, some of those sentimental pieces go a long way of, you know, I get that maybe the monetary value of what you're getting is not the same, but I want you to know I'm leaving my wedding ring for you, or just something along those lines. But then at the end of the day, knowing that you did your best and the fact that you even thought about it and really struggled over these decisions show that you're trying, and hopefully your family understands that. I mean, that's bottom line. So I'm not sure there's like a great technical answer to that question, but I think that's the reality of it.
I think, like you said, though, just being patient with the process and being patient with yourself is very important. I mean, when I start to have this conversation with clients, I always feel like sometimes people get antsy of like, we need to get this figured out. I mean, it's not like something you're going to get figured out in 6 months. Like, I think it's a multiple year kind of have the conversations, think through it. I mean, like Spencer says, get something out there, what you kind of think today, but let's start to refine it over a period of time. And like, don't get antsy about it and give up on it. Just take it as you can do it.
I think it's also super helpful to have a conversation with the heirs individually and understand what are their motivations, and just seek to understand before you set up your own planning. And if you're hearing from heirs that land is important to me, I'm not farming here, but this land has been in the family for 150 years, and I'm a member of this family, and I want to do my part to carry that on. That's a totally different conversation. We've got tools that can help with that while supporting the family that, or, you know, the heir that is farming 10 other pieces of ground that haven't been in the family for 150 years. Then, you know, mom and dad are worth $3 million and I want to make sure I get $1 million of value. Those are different conversations. And so I think if you have those with the heirs and you can come to the advisors and say, it's really important to this child, they're not involved in the operation, but land ownership, preserving the family legacy is important. What tools can we use to enable them to do that, even though the value might not be?
Yeah, I would sediment pretty much all of that. I think it's kind of the whole Wizard of Oz, right? Kind of just pull back the curtain. Because sometimes if they're not, say, financially savvy, sometimes just seeing the financial world, like how much does it? I've never seen it. I'm just curious. I know we have a bunch of land, but I don't know what this looks like. Sometimes it's the financial conversation. Sometimes it's the soft conversation. Sometimes it's just setting those objectives. What is the most important thing? Is it that this land was transitioned to us and we will transition no matter what? Okay. It's a little hard-headed, but that might be the objective. I think it's super key to get everyone, they go back to stakeholders. What is everyone's key to this? Because it might be where one family member is independently wealthy and they're not on farm. They just want to, Tyler's point, they just want to make sure everyone goes to Thanksgiving. That might be their biggest objective. So there might be someone that is struggling and $50,000 could be important to them. Well, there might be a scenario where we hit that without having to worry that we're going to upset Tyler. So get everyone's objectives and then put it in paper and then put a timeline that we're going to meet again at this time. And we're going to just keep inching along, whatever that might be. So it's a long horizon.
Any more questions, Maria?
If you have one, can grain or grain income go into a CRT or does it need to be hard assets?
And we're really in the, I'm gonna, since it's happy hour time, just provide this person with my card.
The next presentation is now and a half on CRTs.
You're welcome to ask Spencer. Happy hour about CRG. Well, if not, we want to thank you all for coming. Thank the panel for for your advice and commentary. And if you have time and want to stay around, we'll have happy hour and answer more questions. Have a discussion, whatnot. I appreciate you taking the time.